to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon. And today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and answer any questions you might have. And thank you for attending. I really appreciate that. For those of you who are new, please step in first. Always want to welcome new subscribers. I like when you ask questions. Please type them down. Mark, Vamsadar, welcome back. Vladimir. For those of you who are new, if this is your first event, the difference between Tradespoon and other services is that my background is technology. Right? I have master's degree in computer science. I work as a CTO of several financial startups, broker dealers. After they went public, decided to build a team of financial engineers to generate signals in the market using latest advances in artificial intelligence and neural networks. And I'm actually using these signals to manage my own money and trading in live trading room. So that's kind of the difference. Been doing that for many years, over 20 years. Disclosures are very important. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept them in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. All right, before we jump into a trading plan, let's talk about current market conditions. So we just had PCE data, which came in, I think, exactly in line with the expectation, right? Unless I missed something, it came in, expectation 0.3, April 0.3, year over year. So no new information. And usually for the market, no new information is good. And you do see a pretty steep drop in yield, right? We went to almost 4.7, 4.63, revisited almost the recent highs, and that interest-sensitive sectors had pulled back significantly as a result of that. And now yield back to 50-day moving average, right? Probably retrace maybe half of the gains in recent. So that's bullish for the market. Lower yield has been bullish for the market. In the past couple of days, again, we have this divergence, right? Usually in the past 2 years, lower yield means Fed is going to lower interest rates. So that's the good news, right? Bad news in the market is good. Bad news is good for the market because yield is down and probability of Fed lowering interest rates is higher. Today, market has been kind of, on the edge, right? Especially QQQ, right? QQQ pulling back. It broke through the overhead, through the breakout level, right? We had NVIDIA earnings and CPI data, right? This is the CPI print on May 15th. We broke above that level, and now we're breaking down below and approaching 50-day moving average on QQQ. And similar price action in spiders, right? Spiders also broke through the 524 level, the breakout level, now trading below that, despite lower interest rates. Small caps are flat, right? They did break below 50-day moving average, but now rebounded back on lower interest rates. So interest-sensitive sectors have done well. Dow Jones and value stocks, so anything outside of technology like Dow Jones, DIA, is actually retesting May and April lows, which is very important level, which I would keep an eye on, around 377, right? And I usually look at the positioning, right? You can look at the stock forecast toolbox to see, right? You can type in DIA and look at the prediction model, see that DIA is oversold and should bounce back. So it's turning positive on Dow Jones, basically saying that, we can get maybe a little bit lower, but this model basically says this level will hold. So 378 level. I usually look at the positioning, right? So here I'm looking at dealer exposure. I'm looking at the strike prices with the highest open interest. Even if you're not an option trader, it's very important to kind of look at these levels so you can determine probability, right? You're not going to know with 100% certainty, but you can tell based on probability what other people think, right? And what other people do, how well they are hedged, right? So right now, DIA the largest volume in weeklies, right? We have weekly expiration today and next week. Not a lot of volume. You have currently right at the 379 level. There's some support, and 367 next. That's weeklies. And then monthly expiration, June 21 and July. The next level positioning is 371. So you really, I mean, you have a little bit at 380 where we're trading, but next level is 371. So basically people are hedging 200-day moving average, but they're not hedging 378, 379 level. So short term, it's oversold, right? You have this wave A, right? You do have strong wave A. Potentially you could have a bounce back to the 50-day moving average, and then is there a wave C, right? Wave C. Right, same setup we had in April, right? A, I said B, right? And then I thought we're gonna have actually bigger, you know, potentially could have had a bigger C, right? But never happened, right? We kind of did double bottom, right? And then off we go, right? Kind of this shape we got. So one scenario we could have C, the other scenario kind of same thing, recover to 50-day moving average and then bounce back, right? So those are your two choices. You know, the idea is to trade what you see, not what you think. And right now I see it definitely weak, right? Especially value stocks are weak, interest sensitive sectors are weak. Oversold, they should bounce back, right? And we see, you know, IWM bounce back, KRE bounce back. So we don't have a broad-based sell-off, right? But the interest sensitive sectors were leading the market to the downside last week. And then today technology, right? The Microsofts of the world, the Amazons of the world are leading the market to the downside. So a little divergence, right, in terms of interest rates and dollar, right? Dollar also pulled back, 10-year yield pulled back, but at the same time, QQQ and Spiders also pulling back. It's a healthy pullback, you know. I think probably anything above April lows would be considered healthy pullback, even if 50-day moving average doesn't hold, right? But for now, I would watch. We're below 523, right? Let's assume we're going to close at these levels, below 520. Spiders, I would look at 520, right? So we looked at the Dow Jones. There is really no hedging up until 200-day moving average. So Dow Jones is vulnerable, right? We had CRM earnings down 20%. We had Dell earnings down 20%. That could create vulnerability for Dow Jones, where it could drop to 371 because people are not hedging. Spiders is actually in very similar position. Spiders is in very similar position because we do have weekly expiration today, May 31st, and we are pretty well hedged at the 515, 520 level. But these options expire today, right? So next week, 7,000, that's not really a lot. So next Friday, 3, 4, 5, June 7th. Let's put all, well, these are irrelevant. Yeah, this is so next Friday, June, we don't really have any large position at 520. The 520 strike, where we had huge position for this Friday for the PCE data, they are basically coming offline, right? They're expiring today. So next Friday, we don't have any hedges till 515. And if you look at the June expiration, right, anything meaningful in terms of position is 510. So once the options expire, once the puts expire today, if you look at the June position, we don't really have, nobody has been hedging until 510 level. And then you do have a large position in 510. So between now and June expiration, right, in the next 2 to 3 weeks, we do have a pretty, you know, this is pretty bearish price pattern, right? We have, I think, 2 weeks in a row. Spiders kind of reversal 1 week, Dow Jones 2 weeks in a row, right? Dow Jones, we have 2 weeks of pretty sharp sell-off, very similar to April sell-off. So we got to watch this level and see if 380 will hold. And spiders, we're trading below the breakout level, only 1 week. But if this level does not hold, right, the 5, that's the breakout level. That's going back to, right, so we're trading below 524, the breakout level of April highs. So if we don't hold this level 520, right, and we are going to trade below 520, you know, Monday, Tuesday, that basically opens up the door to at least retest this neckline around 512, right? That's the neckline, 512. That was the support last time. So pretty vulnerable setup. I'm not sure what can save the market or change the direction, right? NVIDIA earnings are down, Dell earnings are down. So earnings season, we don't have next earnings season until July. And we're basically looking at the macroeconomic data, right? We're looking at the macroeconomic. The next big event would be unemployment data, right? Kind of same idea. Good news is bad for the market, bad news is good for the market. So that is something that I would keep an eye on. And in the so any questions before we move on? Any questions? Bob, 1042, thank you for arriving. I appreciate it. BJ, Bob, Chuck, Don, Ernest, Kevin, Mark, Martin, Peter, Vladimir, Better, F. Smith 70. Any questions? Mark G and Texas Instrument comments. So I think we're going to have a choppy market, right? Texas Instrument. I do have a position in Texas Instrument. It's in July, I believe. So I do have time. We do have support at 185. So it's in strong uptrend. It's consolidating. Short term, I think there is a volatility, choppy market, but I think the July positions, I have time. And this is still a strong uptrend. So I'm still bullish on Texas Instrument going into July. General Electric, obviously, is still above 50-day moving average, did not break this trend line. It does look like a double top, right? It just depends on market conditions. You know, is this pullback 5% or is this pullback 10% or is this pullback 20%? I don't anticipate even 10% pullback. 5% pullback, I think, is very reasonable, right? To kind of like last time. So 5% pullback will take us to 505, they'll call it 500 level. So 500 level or retesting the 494 level, I think it's totally within the realm of possibilities. As of right now, at least for the next 3 weeks, I don't think we're going to break 512. It doesn't look like 520 will hold, right? The 520 level probably will not hold. So it looks like we will dip below 50-day moving average to 510 level, right? I did Dow Jones, DIA put spread last week. Over the weekend, I'll probably put another put spread, maybe in spiders, because I don't think 520 level will hold. But core scenario, we get to 512. I think worst case scenario is of right now, we retest the lows, which is 5% pullback. It's considered to be a healthy pullback, pattern of higher highs and higher lows. So July position, there is still time to decide. June positions are vulnerable, right? So I have Amazon position in June. And it's, precipitously selling off, right? So at this point, I would need to close, if I'm down close, I'm getting close to 50% down on Amazon position. I don't want to be down more than 2.5% of my account value, right? Ideally 1%. So I'm down right now close to 1%. I'm $10,000 account, I'm down 1%. And this looks pretty bearish setup, right? Amazon is at the forefront of AI revolution. They had good earnings, stock rallied, so it's selling off, probably because it was the rest of the market, right? And it's a bearish price pattern. We already basically retesting, April, May lows, which is not a good setup. So June, you don't have a time. If you see breakdown of major moving averages or major support level, then I would exit the position. So I have Amazon. technology, and then Wells Fargo. Wells Fargo is dipped below 50-day moving average briefly, but it's recovered. It's actually turning positive despite market pullback. So, I think Wells Fargo, I would still be bullish. Bob, GPS worked well for me. So yeah, so GPS, good trade, right? We talked about this large asymmetrical move. Asymmetrical moves like some of the retails, GPS or ANF, right? You have these 20-30% move to the upside, right? Vertical moves to the upside. You have the other way, calls, 20% move to the downside. You have CRM, 20% move to the downside, and then you have Dell, right? 20% move to the downside. How do you take advantage of this information? Again, in the live trading room, if you watch, let's say yesterday, right? Bob, I don't know. Bob was there, right? Bob was there. So we did, Bob did, I don't know, Bob, did you do NVIDIA? Not NVIDIA, did you do Dell? But this is an example of kind of where you can look at the positioning, right? Like Dell, right? You can look at the positioning data, and I bought a put spread for 84 cents, and I sold it today for $4, right? So I bought a put spread, I bought a call spread, and I spent $1.50, $1.60, and I closed it for $4. And right now, I think it's actually trading closer to $7. So this is an example where sometimes these 100%, 200% returns, they do happen, right? It's a idea of probabilities of success and looking at the demand and supply, right? We looked at GPS, we looked at Dell, right? We looked at Dell positioning, and for an example of Dell, right, there were a lot of, this is reversed now because of the earnings, but yesterday there was a very large positioning, right, at these I think we were saying let's see, July, right? I think we calculated 40 points to the upside, 40 points to the downside. So there was very large call buying at 180 and 200 level. So I said one outcome that we can go from 170 to 200 or to 210. The other outcome, we can go from 170 to 130 because there were a lot of put buying for this week, right? Put buying. And by doing the butterflies, right? Bob decided to do straddle, right? Buy and call and buy and put. But the problem with straddles on GPS, you would have to spend 10% of underlying stock. If the stock is $22, you have to spend $3, $2. I think the straddle would cost. But obviously, if it does move 20%, you can have these large returns. More conservative approach, more frugal approach, where you're spending less money, is buying butterflies or condors, right? So if you look at butterfly profit and loss image that we looked yesterday, right? Ideally, you wanted to gravitate toward the middle strike, right? So like lone butterfly, right? So as long as you trade in, if you can identify a range where the stock can trade, right, then you can profit from them. It doesn't have to be exactly at that level, right? But you can profit as long as it reaches that range. And earnings season, because of the AI theme, has been extremely volatile. And we see it in retail sectors this year, this cycle, and we see it the same thing in AI stock, right? CRM, Dell. So if you think that the stock can move 2 standard deviation move, right? You look at estimated move analysis, look in the implied volatility. I looked at dealer positioning, looking at the strike prices. Then you can identify the range where the stock can trade, right? On the upside, it was 180 to 200 based on these high strike prices. On the downside, it was 130 to 140 to 130, right? So once you see, based on estimated move analysis and based on the highest open interest where people are trading, then you can set up these trades where you're risking, in this case, I risked $1.50 on $200 stock. It's less than 1%, right? So I risked 75 basis points. I could have set it up where I'm risking 0.5%. And, in this case, I almost, triple my money, close to tripling money. And if you're still in this position, then it's a lot more expensive. Whereas Dell? Yeah, Dell continues to deteriorate. Dell continues to deteriorate. All right. Next Wednesday, June 5, FOMC meeting. We have FOMC meeting June 5. Okay, let's look. I'm not sure about FOMC meeting on June 5th. I think it's the following week. We have unemployment data. I think that could impact the data. We do have, I think more important, we have, I think what can drive the market, and maybe that's one of the reasons we are actually, technology is under pressure along with the other market, is the Japanese yen, right? So there's rumors that, again, Bank of Japan will intervene, right, and try to stabilize the slide in Japanese yen, right? So that's supposed to happen over the weekend. I mean, it already happened in May once. We had a pretty sharp reversal, but at this point, it didn't work. So I think they're gonna, put a lot more money trying to stabilize, start buying yen. And next week, I think we do have ECB decision, right, and Bank of England decision. And the expectation that the economy is a lot slower in Europe. Let's look at how's Germany is doing. Germany is actually it's above a pretty strong, above 50-day moving average. But the expectation if the bank, if they are going to actually cut rates in Europe and England in, let's say, June, right, or July, and in the United States, it might not happen till September or not at all, right? Nobody knows. Again, this cost of carry trade could also influence market conditions, right? So something to keep in mind on the currency market as well. Right now, dollar is, it's trading between 50 and 200-day moving average, right? We do have kind of a precipitous drop in yield, and also, semiconductors and QQQ are down as well, but VIX is actually very low. Thank you, Kevin. BJ, emerging market in China. I'm long China, even though I don't like the chart that much anymore. All right. It looked very bullish, right? We have 4 weeks of this continuation of higher highs, higher lows. And right now we gave up half of the gains, right? So 50% retracement. I did buy a put. So the good news, I do have stock and I have a put. So I think it makes sense to hedge your position. You can buy a put or put spread, or you can sell calls. You can do both, right? You can do color where you buy a put spread, sell a call. But at this point, it's at 50% retracement. You do have a neckline. That spans for majority of 2024, 3 and 2024, right? This was a breakout above, that's why I got bullish, but looks like we're retracing back. I think as long as we're above this trend line, there's still a strong bullish momentum. We're trading lower on a lower volume, right? Volume is not spiking. So for now, I think it's still kind of in consolidation, healthy pullback. If we do drop below 26 level, right? If we drop below 26, below this red line, I think then bears are in control. So for now, I would use FXI. I would use, a put spread, right? Because you don't know which way it's going to go. And until it actually stabilizes, I propose to use put spread. So I have FXI and I have a put. Gold miners, NEM, I'm bullish. I have silver. I have SLV position. Newman mining, I mean, it's underperforming GDX, right? It's underperforming GDX. It's underperforming XME, right? Personally, if I see stocks underperforming ETFs, right, unless you're doing fundamental analysis, right? I don't look at the balance sheet, right? I don't study their cash flows or debt, right? So I look more of a charts and macroeconomic conditions. So from macroeconomic conditions, since inflation is kind of stubbornly persistent, gold miners look like they broke through this overhead resistance, consolidating, right? Silver looks like it's, at multi-year high, consolidating, but still in a strong uptrend. Personally, I would go with ETFs, right? Silver, gold, metals, XME, but something along those lines. How would you structure Spider's put spread strikes would be selling and buying? So, very good question. I would look at the positioning. And first, I would look at the model, right? So what does the model say for Spiders? Long term, we're still in strong uptrend. Model determined for months of January, the overhead resistance is 533, support is 501, right? We were basically at both extremes. So model did a good job for the months of May, identifying support and resistance. It will recalibrate again tomorrow on June 1st. It will update these predictions. I assume since we did not go outside of this range, we're still going to remain in a strong uptrend long term for the next 6 months. Strong uptrend, but for the months of June, probably again, 500, 505 is where you could revisit. You could see market either April lows at 495 or this psychological level 500. And on the upside, potentially getting to the 545 level, right? So I think that's a reasonable range to expect for the months of June. And direction is still to the upside long term. And in terms of positioning for Spiders, right, we looked at the June. We looked at June and we looked at July. 510, right? You have relatively large positioning at 510, not huge, 30,000. I would not say that this is something of any size. 500 is the biggest concentration of puts. So people are buying 500 puts in very large quantities, maybe 1 to 2 quantities of 510. So somewhere between 510 and 500 is reasonable to expect that the market could reach. So I would personally do maybe, let's look at the prices. I would go into July, right? I would go into July expiration, kind of hedge before the next earnings season. So let's say we buy 520 and sell 510. So here you hedge 2%, right? One contract, $1,000, right? 10%, on a $10,000 portfolio, you hedge $10 minus the debit. So you're paying debit of $3 to make $7. So I would use either 520, 510 and spend $3, right? And exit out if the market reverses, exit out if you're down $1.50. If you want to be a little bit more aggressive, you think there is, 510 is actually not going to hold because there's not that much positioning. You can definitely do 520, 500. You would have to spend, $5 instead of $3, right? It will be more expensive, but then you hedged all the way to 500 level, right? And this is, again, $520 ETF. So $20 times 1, $2,000, right? Then you have a pretty large position. So, and that would imply 4% pullback. So if you think there's going to be another 4 or 5% pullback, I would do 520 to 500. If you think the pullback is going to be another 2-3%, I would do 520, 510. And kind of similar I did, I think, DIA, right? Last Friday in the live trading room, right? When DIA dropped below 50-day moving average, same kind of idea. I bought it at 330, it reached April lows. I closed it at 520, right? So hedged my position, and now I'm waiting, right? If Dow Jones breaks down April lows, I would put on another DIA put spread. If Spiders drops below 520, that's probably, a sign that you want to, put on the hedge, right? Right now, we're kind of fighting for this 520 level. Right, we're exactly at 520. So I think 520 will hold because these people still have puts, but Monday, Tuesday, we better, bulls would want the market to rebound, right? Because if Monday, Tuesday, we have a continuation of the pullback, then we're probably going to quickly get to 510, 512 level. Chuck, let me know if it makes sense. Yeah, Amazon, let's see. So Amazon, I mean, it rotates. I don't think it's out of Magnificent Seven. It kind of every day is a little bit different. I mean, Microsoft was kind of precipitously dropping yesterday and continuation today. So whether it's Microsoft or Amazon, I think they're kind of in the same boat. NVIDIA is doing better, right? Even Netflix is down also significantly today, 2%. So I think all the Magnificent Seven stocks, because they were outperforming, right? They're now basically following Dow Jones stocks, right? Everybody else sold off, Netflix and Amazon did not, and today it's Amazon, Netflix, and Microsoft. So I would watch these support levels, right? If Netflix breaks through this level, then I would exit Netflix position. Amazon, if it's options, you really don't have time. I mean, it is 2 standard deviation move. So in theory, we should have some kind of a rebound next week. But, we do need the 520 level to hold. Goldman Sachs is turning positive, right? We have NVO positive. So again, energy is positive, biotech is positive. So that's a good sign. That's a good sign that we are approaching the bottom, right? Or we're trying to find the bottom. Long-term done, GPS straddle bot, very nice trade. I'm glad it worked out. All right, eBay. So yeah, I forgot. So Bob GPS, he did buy put and bought call, right, near the money. So, but GPS moved 20%. So this is, again, you get these asymmetrical returns. So the question is, do you want to be long volatility or short volatility, right? If you anticipate 2 standard deviation move, you want to be long volatility, right? You want to buy butterflies, straddles, condors. If you want to sell, then you want to do credit strategy. If you want to take advantage of volatility collapse. So eBay long term, I mean, it looks strong, right? It's consolidating for many months. It broke above this level. This is considered to be a very bullish price pattern. It did pull back to 50-day moving average. But as long as it's above 50-day moving average, it's on strong uptrend, eBay. All right, then you had 2 earnings, positive earnings, this is negative earnings. So for now, eBay, as long as it's above 50-day moving average, I think it's strong. Robinhood is the more of a crypto play, right? It's been strong. It did break through the 20 level. It's pulling back. I mean, it's the same thing as buying Bitcoin. Bitcoin is above 50-day moving average. It hasn't broke above all-time high, but it's kind of, it rebounded. It was, pretty vulnerable position below 50-day moving average. But for now, it's still holding better than, I mean, similar to spiders in QQQ, right? It's above 50-day moving average. It's pulling back. all of these sectors are very sensitive to the interest rates and high yield, right? High yield also dropped below 50-day moving average at rebound. That's, that's a sign of concern, but we're above 50-day moving average. If we make another leg down below 76 on high yield, again, the sell-off will accelerate, right? So kind of bulls and bears are just digesting the data, maybe preparing for next Friday unemployment data. But for now, they're fighting for these major support levels. So long term, I think it's a pattern of higher highs and higher lows. Whether Robinhood or Bitcoin, it's a proxy for risk taking, and I think risk taking continues. But it's not going to be a one-way, trade, right? We've seen Dow Jones revisiting, DIA already revisited, did 5% pullback. This is the second time. Bob, GPS trend goes Z-scale, all the earnings, auto losing all the earnings gains. So Z-scaler, right? Looks like a reversal on Z-scaler, Alta. Yeah, complete reversal, right? Up, down, 10%. So very volatile market. NTAP, I think, had earnings. NTAP is still holding on to its gains. Marvel is also down 12% today on earnings, right? So you do have these sharp moves to the upside, to the downside, implying that it's a stock picking market, right? You have to be careful what stocks you pick if you don't want to be vulnerable, because Marvel is a good company, right? If you do, or even Dell, I think Dell was a great company. A lot of people probably got caught by surprise from Dell earnings. So then you trade ETFs. Credit or debit spread. So I'm bear. If I'm putting the spider, I'm bullish long term, but short term, I think market is vulnerable for further pullbacks. Since I don't know what's exactly is going to happen, but I have long position, right? I have Goldman Sachs, I have Wells Fargo, I have Netflix, I have Amazon. So I have long position. One way to hedge these positions is buying debit put spread, right? So I'm buying 520. I would buy either 520, 510 debit put spread, right? This would be a debit price, right? For $3.10, right? I would do it as a debit, either debit of 310, or if you are concerned with 5% pullback, which is totally possible, then you spend $2 more. Then you would spend $2 more, right? But this way you're hedged for 4 or 5% to the downside. Bob, AEM is way better than Nucor. Okay, if you want to know individual stock, you just ask Bob. AEM. This is a good chart, right? AEM is a good chart. So if you're interested in individual names, then AEM looks like a much better chart, and it looks better than GDX, right? So then it makes sense to take the risk of individual stock to me, right? GDX and AEM, I think they look pretty close. Pretty close. If they look pretty close, I still rather do the ETF. All right, any other questions? It's 10:12. All right, so very important, I encourage you to participate in live trading room. We have live trading room every morning, first hour of trading session, last hour of trading session. So I spend a lot of time going through how to set up your trading plan, how to do risk management, right? So very important topics. I encourage you to participate and join us. Number of positions. If you have $10,000 portfolio, number one rule is the process. Right? You want to set up a repeatable process that you can follow alone or give somebody else to follow. Part of the process is keeping journal. I encourage you to have no more than 4 positions at a time, and maximum loss of 2.5% of account value per position. Right? If you have $10,000 account, you do not want to lose more than $250 per position. Right? If you're consistently risking less than 2.5% at any given point, then I think you have a repeatable process and you know when to exit. And more importantly is, you're not vulnerable to, prospect theory, right? Prospect theory. You have asymmetrical relationship, right? Asymmetrical relationship between pain and gains, right? In gains, you're happy, but when you make $500, you're happy, but when you lose $500, your feelings are 4 times, bigger than the gains. So for that reason, because of the loss aversion, we often do not exit when we're down, 2.5%. So important to understand the theory, important to understand that this happens to everybody. One way to deal is keep a journal, and when you see that your position reached 2.5% lower, then you exit the position. And one way to prevent that is, again, use dollar cost average. So you split position into 2, right? At any given point, you're risking 1%. And if you're down 1%, then you can make a decision, right? Like in Amazon, if I'm down only 1%, I mean, it's a strong stock. Maybe the market is oversold. Maybe it will reach the bottom and it could recover, right? Maybe close June, roll to, July. But if you're down more than $250, then you really don't have time to roll, or you should just exit the position, right, and follow your trading plan. All right. Any other questions? Bob, have a great weekend. I will see you guys. We do have a closing bell. Next week I'm traveling. We will have morning bell. Scott will cover morning bell. I'll be there on Monday. We'll have opening bell and closing bell on Monday. We will have opening bell every day, but Tuesday, Thursday, and Friday of next week we will not have closing bell. So there's no closing bell on Tuesday, Wednesday, and Friday. Sorry, Tuesday, Thursday, and Friday. Ernest, thank you. We appreciate it. Don, thank you. Kevin, yeah, I mean, elections, trial of Donald Trump. I mean, for now, it's not, I don't think it's translated into the stock market, but at some point it will affect the same way. All right, guys. You've been great. Thank you very much for attending. I appreciate your time. I will see. So we're not going to have a strategy roundtable next Friday, but following week we'll be back to normal schedule. And I hope you guys can make it. Thank you very much and have a great day.